Welcome to our analyst team's 2015 video presentation on Key Energy Services Incorporated. This analysis is a part of Burke & Road Reports, an equity research program at Tulane University's A.B. Freeman School of Business. Analysts are Taylor Gaines, Liam Green, Edward Sapp, and William Smith. The investment research manager is Catherine Greisman, and the associate director is Jerry DiColo. This presentation will provide an overview of the company, detail our equity valuation, highlight recent company developments, and outline our investment thesis. Please note that at the time of this report, on March 9, 2015, our analysts were still awaiting the release of updated financial information for the first quarter of 2015. Key Energy Services, listed on the New York Stock Exchange with the ticker KEG, is an oilfield services company headquartered in Houston, Texas, that operates both domestically and abroad in Colombia, Ecuador, Mexico, the Middle East, and Russia. The company operates as the largest onshore rig-based well servicing contractor. Key Energy provides a wide range of services that aid in the drilling and extraction of oil and natural gas, including coiled tubing, fluid management, and fishing and rental services. At the time of our report, on March 9, 2015, Key Energy was trading at $1.78 with a market capitalization of $274.8 million and 154.4 million shares outstanding. Here's a look at the past 10 years' performance for Key Energy stock. Following the 2008 recession, on February 23, 2009, Key Energy traded at a low of $2.26. On July 25, 2011, Key Energy traded past its pre-recession highs at $20.48. Since that time, the stock has seen high levels of volatility. Key Energy stock is currently trading below financial crisis levels. Our analyst team arrived at a 12-month target price of $2.52 by taking the even weighted average of price targets derived from peer group trading multiple valuations. The three multiples used in our weighted average calculation were price to book value, price to cash flow per share, and the EV over EBITDA ratio. Because the majority of oilfield services companies are suffering negative earnings, we are unable to use earnings-based valuations such as the price-to-earnings ratio. We did not include any discounted cash flow valuations into our target price as they do not produce sufficiently reasonable results. Key Energy mainly competes in the $115 billion U.S. onshore oilfield services industry, as its international revenues accounted for just under 15% of its total revenue in 2014. Throughout the third and fourth quarters of 2014, oilfield service companies were hit hard by a collapse in oil prices. U.S.-focused oilfield services companies are expected to struggle over the next year as exploration and production companies cut spending and halt drilling. Exploration and production capital spending is the driving factor for oilfield services revenues. Although Key Energy identifies several competitors across its multiple business segments, company management has acknowledged that primary competition comes from large multi-service corporations, specifically Nabors Industries, Basic Energy Services, Superior Energy Services, Forbes Energy Services, and Pioneer Energy Services. Most of Key Energy's competitors focus regionally on the Permian Basin in western Texas and the Bakken Basin spanning North Dakota, Montana, and Canada. Institutional investors hold almost all of Key Energy shares. High institutional ownership helps explain the large following of Key Energy by equity research analysts. 21 research firms and banks cover Key Energy's stock. This is a large amount relative to other equities in the Burken Road Reports portfolio. Key Energy's financial performance has suffered in recent years, and the company is now being plagued by depressed commodity prices at a time in which shareholders should have started seeing recovering financials from improving operations. Most of Key Energy's latest developments are focused on the company's fiscal health and ongoing investigations. The company is currently winding down an internal investigation into allegations by the Securities and Exchange Commission and Department of Justice of potential Foreign Corrupt Practices Act, or FCPA, violations connected with its Mexican and Russian operations. Related first quarter 2015 charges could be significantly reduced as expenditures are typically confined to the beginning of an investigation. Since the start of the investigation, the company has incurred quarterly charges of $5 million, $16 million, and $20 million successively. The end of this FCPA investigation will significantly improve Key Energy's bottom line and allow the board and executives to refocus their energy on operations. Caused by a global supply glut, oil prices have plummeted by more than half since this summer. This price drop will hit Key Energy and the oilfield services industry hard as rig counts drop sharply and forecasted exploration and production capital spending is slashed. This oil downturn is predicted to last much longer than others as it is caused by an oversupply and paired with weak global demand outlook. In December 2014, Key Energy amended its credit facility to relax its debt covenants. Despite seeing decreased commitments into the future, this amendment provides a net increase in near-term liquidity. Additionally, the company expects to solidify a new credit facility in the first quarter of 2015 before the newly amended credit facility becomes current. Our equity valuation of $2.52 is dependent on a moderate oil price increase in the second half of 2015, sufficient liquidity and manageable covenants achieved through a first quarter refinancing of its credit facility, a wrapping up of internal FCPA investigations, sustained growth in demand for larger workover rigs, and stronger international performance led by Mexico. With cost-cutting measures underway in a challenging 2015 market, Key Energy will depend largely on its U.S. rig services segment as its workover rigs continue to see increased activity. The company's larger workover rigs continue to account for a bigger share of the segment's revenue, which accounts for half of total revenue. Workover rigs prove resilient when new drilling halts. This makes the segment even more important to Key Energy's 2015 performance. Unlike the 2009 oil depression, Key Energy is now committed to maintaining net positive cash flow work through this cyclical downturn, even if it means losing market share. The company's ability to slash capital expenditures and right-size its operations as oil prices remain depressed will aid executives in managing cash. Over the next year, Key Energy's performance will depend on if and when oil prices settle and where they settle in this supply glut. In this one-year graph comparing the performances of the Crude Oil Volatility Index and the Oilfield Services Sector Index, it is clear that oil volatility is bad for the oilfield services sector. As previously noted, fundamentals would hint that oil has not bottomed out despite its stabilization of around $50, and that another drop in the West Texas Intermediate spot price could occur in the first half of 2015. Our analyst team predicts an L-shaped recovery of oil prices or a much longer than average recovery. Assuming oil does not plummet again and that the company's creditors can provide Key Energy with a flexible credit facility in the first quarter, the company will be well positioned to withstand this cyclical downturn as it looks to produce strong cash flows through services that are shielded from drilling and completion activity. Thank you for watching this spring 2015 Burken Road Reports presentation. We would like to remind our audience that the Burken Road Reports are produced solely as a part of an educational program of Tulane University's A.B. Freeman School of Business. The reports are not investment advice. Investors should not regard the presentation as a recommendation to sell or buy any securities mentioned. Investors should consult an investment professional and/or conduct their own primary analysis before making any investment decision.